Financial statements serve as the formal reports that communicate an organization's financial performance and position. These documents are vital for stakeholders, including investors and creditors, to make informed economic decisions. We focus on four primary financial statements: the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. These statements do not exist in isolation. They are mathematically interdependent, meaning data from one statement flows into the next to provide a complete picture of business health. By examining these reports, we gain the transparency required to analyze organizational viability and strategic direction. Financial reporting is comprised of four primary statements. These are the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. These statements must be prepared in a specific logical sequence. Information from one statement serves as the foundation for the next. The income statement determines net income, which then flows into the statement of owner's equity to update the business's net worth. The ending equity balance is then reflected in the balance sheet, providing a comprehensive snapshot of the company's financial position at a specific point in time. Finally, the statement of cash flows reconciles accounting performance with actual liquidity, completing the financial picture. The income statement serves as a primary gauge of an organization's financial performance over a defined fiscal period. It is essential for understanding the profitability of a business. The structural foundation of this statement is defined by the following equation: revenue plus gains minus expenses and losses equals net income or net loss. This statement is vital as it allows stakeholders to determine if the company's primary operations are truly profitable, isolating operational success from incidental financial events. Ultimately, it provides the clarity necessary to assess the operational viability of an enterprise. Revenue is the total value of goods sold and services provided to customers. It represents the primary inflow of financial value into an organization. This represents the top line of the income statement. It is the initial pool of resources from which all other operations are funded. Revenue sources vary by business model. Service providers record fees earned for their expertise, while retailers account for sales revenue from physical goods. Ultimately, revenue is calculated by the volume of transactions multiplied by the unit price, creating the financial foundation of the business. Expenses are defined as the costs incurred to generate revenue. They represent the outflows of resources or the incurrence of liabilities necessary for business operations. Common examples include rent for office space, wages for employees, and supplies needed to manufacture or deliver goods. Proper tracking of these expenses is vital for determining true profitability. By subtracting total expenses from revenue, we arrive at the company's net profit. In financial reporting, we distinguish between core operations and ancillary or peripheral activities. Gains and losses result from peripheral activities. They are infrequent and, unlike core revenue and expenses, do not represent the primary business model. For instance, selling old equipment at a profit creates a gain, whereas selling it for less than its book value results in a loss. These transactions affect net income, but are considered incidental to ongoing operations. The statement of owner's equity acts as a bridge. It begins with the equity balance at the start of the period. First, we add net income or subtract net loss derived directly from the income statement. Next, we account for any new capital investments made by the owners, which increase the total equity. Then, we deduct any distributions or dividends paid out to the owners during the period. The final result is the ending equity balance, which is then reported on the company's balance sheet. Organizations grow and gain significant value when owners invest cash or assets into the business. This influx of capital serves as the foundation for operational success and future stability. When an owner transfers personal assets into the company, these resources are recorded as an increase in the business's total equity. In the corporate structure, this process often involves issuing common stock. This provides the necessary capital for long-term projects and major expansions. By effectively leveraging owner investments, a business secures the liquidity required to scale operations and achieve long-term strategic goals. Distributions, such as dividends for corporations or withdrawals for sole proprietorships, are essential components of the accounting process. When a business distributes profit, it reduces the total equity held by the company. As shown here, starting with $100,000 in equity, adding profit, and subtracting $20,000 in distributions leaves an ending balance of $130,000. This flow illustrates that distributions are not an expense of operating the business, but rather a strategic return of value to the owners who provided the initial capital. The balance sheet serves as a financial snapshot of an organization at a specific point in time. Unlike the income statement, which covers performance over a duration, this statement displays the company's precise position at that exact moment. It is governed by the fundamental accounting equation: assets equal liabilities plus owner's equity. This balance must always be maintained. Assets represent everything the company owns that holds value. Liabilities are the obligations owed to external parties. Owner's equity is the residual claim or net worth remaining for shareholders. Together, these sections provide a clear, structured view of the company's financial integrity at a single glance. Assets are fundamental to the financial position of a business. They are defined as resources controlled by an entity that are expected to provide future economic benefits to that organization. In financial reporting, assets are systematically categorized based on their liquidity. Current assets are resources expected to be converted into cash within one fiscal year, such as inventory or accounts receivable. In contrast, non-current assets provide long-term utility, including fixed assets like buildings, machinery, and land. In financial accounting, liabilities represent present obligations to transfer assets or services in the future. These are essentially the debts and commitments a business has accumulated based on past transactions. Liabilities are typically split into two categories based on their due dates. Current liabilities are obligations expected to be settled within 1 year, such as accounts payable. Conversely, long-term liabilities represent obligations due after more than 1 year, including long-term debt like mortgages or bonds. Accurate classification of these obligations is critical for stakeholders to evaluate a company's ability to maintain liquidity in the short term and financial stability over the long term. The statement of cash flows is the final essential piece of a company's financial reporting. While other statements focus on profitability and position, this statement tracks actual liquidity. Most financial statements use accrual accounting. This means revenue is recorded when a service is provided, even if the cash payment is delayed. The statement of cash flows bridges this gap. It reports actual cash inflows and outflows, providing stakeholders with a clear view of the business's immediate solvency. It categorizes these movements into 3 sections: operating activities, investing activities, and financing activities. Together, these reveal how effectively a company manages its cash. Without this statement, one could not distinguish between a profitable company and one that is cash poor. It is truly the essential bridge to understanding real corporate health. Accrual accounting is excellent for measuring long-term profitability, but it can obscure the immediate liquidity of an organization. While an income statement shows profit on paper, it does not reveal the physical cash available to meet obligations. This statement bridges the critical gap between accounting profit and actual cash. It allows stakeholders to verify if a company can truly cover its debts, payroll, and expenses in real time. Ultimately, even a profitable company can fail if it runs out of cash. This statement provides the transparency required for banks and investors to ensure that earnings are sustainable and that the business remains solvent. Accounting principles remain constant, but legal structures define the framework in which business operations occur. There are three primary structures. The sole proprietorship and partnership offer simplicity but carry unlimited liability for owners. In contrast, the corporation provides limited liability, easier access to capital markets, and is subject to double taxation. Each structure presents unique tax and liability implications that significantly affect financial reporting. Sole proprietorships and partnerships are the most common forms of business organization. Both are favored for their simplicity in formation and their tax structure, which avoids double taxation. However, these structures share a critical risk: unlimited personal liability. This means owners are personally responsible for all business debts, putting personal assets at risk. A corporation is a legal entity distinct from its owners. This separation provides limited liability, meaning shareholders are not personally responsible for corporate debts. Corporations offer significant advantages, including limited liability protection and the ability to raise large amounts of capital by issuing shares of stock to the public. However, corporations face a unique disadvantage: double taxation. The entity pays taxes on its earned profits, and shareholders then pay personal income taxes on the dividends they receive. A fundamental pillar of professional accounting is the business entity concept. This principle dictates that a business must be maintained as a distinct unit, entirely separate from the personal affairs of its owners. By establishing a firm boundary, we ensure that only business-related transactions are recorded in the company's financial records. Mixing these domains compromises data integrity and legal clarity. In practice, this means personal expenses, such as family groceries or vacations, are strictly excluded. Only items directly tied to the generation of business revenue are recognized in the ledger. Modern accounting increasingly embraces the utilitarian ethical framework. This perspective posits that organizational actions should prioritize the greatest good for the greatest number of stakeholders, rather than focusing exclusively on shareholder returns. In this framework, the responsibility of the accountant extends beyond the investor. It includes employees, creditors, and the surrounding community. Decision-making seeks to balance these interests ethically. By incorporating these ethical considerations, professional accountants ensure that financial reporting serves as a tool for broader societal health and long-term sustainability. Financial statements serve as an X-ray of corporate health. By synthesizing the income statement, statement of owner's equity, balance sheet, and statement of cash flows, we gain a comprehensive view of organizational performance. This understanding empowers stakeholders to shift from reactive, gut-feeling decisions to proactive, data-driven strategies. This transformation is the cornerstone of sustainable growth and long-term financial stability.